Imposing retaliatory tariffs right now on the United States, hitting billions of dollars worth of goods and energy resources.
Remember when Trump promised to bring back jobs and make America stronger? Well, it didn't go as planned. The trade war was supposed to rebuild the economy, but instead it sent prices soaring, businesses collapsing, and China growing even stronger. Now Trump is back, but the world has changed. America's biggest rivals have adapted. If we do not act fast, the United States may lose its position as the world's economic superpower forever. What's happening? When Donald Trump launched the trade war, he promised a bold economic strategy that would revitalize American industry. His administration framed it as a necessary move to protect U.S. businesses, bring back jobs, and reduce dependence on foreign manufacturing, particularly from China. For decades, American companies had relied on cheap labor and materials from overseas, leading to a trade imbalance that Trump saw as a major economic threat. His solution? Tariffs, massive taxes on imported goods that would make foreign products more expensive, forcing companies to manufacture in the U.S. and strengthening domestic industries. At first, the logic seemed simple. By imposing tariffs on Chinese goods, Trump aimed to make imports so costly that American companies would have no choice but to move production back to U.S. soil. If successful, this would create millions of jobs, restore factory towns, and make the U.S. less reliant on foreign supply chains. His administration assured Americans that short-term sacrifices would be worth it in the long run, painting the trade war as a battle for economic independence. But there was one major flaw in the plan. American companies didn't simply shift production back home. Instead, they found ways to avoid the tariffs entirely by relocating to other low-cost countries like Vietnam, India, and Mexico. Many businesses couldn't afford to move operations at all, which meant they had to pay more for imported materials and pass those costs on to consumers. As a result, everything from cars to electronics to household goods became significantly more expensive. What was supposed to be a move to strengthen the economy quickly turned into an economic burden for everyday Americans. Instead of forcing China to surrender, the trade war created inflation, increased costs for businesses, and disrupted supply chains that had been built over decades. By the time Trump left office after his first term, it was clear that his strategy had backfired completely. But the real damage of the trade war wasn't just in policy. It was in the financial strain felt by everyday Americans. As the cost of living soared, the true economic impact became impossible to ignore. The economic fallout. The moment tariffs went into effect, prices across America began rising. The cost of raw materials, such as steel and aluminum, surged as businesses were forced to pay extra for imports. These materials are essential to manufacturing industries, from car production to construction, meaning that American companies had no choice but to either raise prices or absorb financial losses. Most chose the former, and as a result, consumers bore the brunt of the economic strain. For automakers, the trade war was a disaster. The cost of producing vehicles rose sharply due to the increased price of steel and aluminum. Major car manufacturers, including Ford and General Motors, warned that tariffs would raise production costs by billions of dollars, forcing them to increase car prices for consumers. The result? Fewer people could afford new cars, and demand plummeted. Retailers were hit just as hard. The vast majority of American products contained components manufactured abroad, particularly in China. When tariffs made these parts more expensive, companies like Walmart, Target, and Best Buy had to raise their prices. This meant that everything from refrigerators to smartphones to basic household items became costlier. For middle-class families already struggling with stagnant wages, the impact was devastating. Meanwhile, the tariffs did little to harm China. While American businesses and consumers paid more, China simply found new markets for its goods. Instead of relying on U.S. buyers, Chinese companies expanded their trade partnerships with Europe, Africa, and Latin America. In the end, the trade war punished American consumers far more than it hurt China. As the U.S. economy struggled, China wasn't backing down. Instead of suffering under U.S. tariffs, Beijing executed a strategy that would make its economy even stronger in the long run. China's counterattack. From the very beginning, China understood that tariffs alone wouldn't cripple its economy. Rather than panicking, Beijing adapted. Instead of relying on exports to the U.S., China shifted its focus to new trading partners, and poured money into self-sufficiency efforts. One of its first moves was to strengthen economic ties with the European Union, Africa, and Latin America, when the U.S. made it more expensive for China to do business. Chinese officials secured massive trade agreements with other nations, ensuring that their manufacturing sector remained strong. They forged new deals with African nations, increasing their economic influence on the continent, while securing long-term access to raw materials and key resources. China also expanded trade with Latin America, investing in infrastructure and technology to deepen its economic foothold in the region. At the same time, China poured billions into developing its own domestic industries. It accelerated investment in semiconductor manufacturing, electric vehicles, and artificial intelligence, making sure it no longer relied on American technology. Beijing's long-term strategy paid off, allowing China to lessen its dependence on U.S. exports while building a more self-sufficient economy. Currency manipulation also played a role. China devalued its currency, making its goods cheaper for foreign buyers. This offset the impact of tariffs and helped Chinese manufacturers stay competitive. In contrast, American companies struggled, unable to adjust their pricing as easily. They continued losing customers. By the time Trump left office, it was clear that China had not only survived the trade war, it had used it to become even stronger. The country's economy continued growing, while the U.S. faced rising debt, economic instability, and declining global influence. But while China strengthened its position, U.S. corporations saw the writing on the wall. Instead of waiting for relief from the government, they took matters into their own hands, and that meant leaving America behind. The corporate exodus. While Trump's tariffs were meant to bring jobs back to the U.S., the reality was far different. Instead of moving their factories home, businesses left America altogether. Large corporations, including Apple, Tesla, and Ford, relocated their production facilities to countries like Vietnam, India, and Mexico to avoid the rising costs caused by tariffs. For many companies, staying in America was simply too expensive. Labor costs were higher, raw materials were more expensive, and supply chains were already built around international trade. Rather than absorbing the higher costs of production in the U.S., businesses chose to set up operations in other countries with lower wages and fewer trade restrictions. Mexico became a major winner in this shift. Many companies, particularly in the auto industry, moved production south of the border to escape tariffs while still maintaining access to the U.S. market. Vietnam and India also saw a surge in manufacturing growth as companies diversified their supply chains away from both China and the U.S. The unintended consequence: instead of strengthening U.S. manufacturing, the trade war pushed businesses even further away. Factories did not reopen, jobs did not return, and American workers were left behind as corporations adapted to the new economic reality. But while corporations adapted, small businesses and everyday workers weren't so lucky. The true economic pain of the trade war was felt most by those who had no power to escape it, and that's where the real crisis began. The American manufacturing collapse. Why jobs never came back. For decades, the United States had relied on overseas production to keep costs low, particularly in industries like electronics, automobiles, and steel. The assumption behind Trump's strategy was that if imports became more expensive, American companies would have no choice but to move manufacturing back home. However, this theory failed to account for one major problem. American businesses couldn't compete with cheaper labor, lower production costs, and more efficient supply chains in Asia. Meanwhile, American factories shut down because they couldn't keep up with the rising cost of raw materials. The price of steel and aluminum, key components for industries like construction and automotive, spiked as a result of Trump's tariffs. Instead of increasing domestic production, this caused companies to scale back operations or shut down entirely. Layoffs surged across the manufacturing sector, contradicting the very promise that started the trade war in the first place. The impact on American workers was devastating. Those who lost their jobs faced limited employment options as the manufacturing sector shrank and alternative jobs required completely different skill sets. The idea that tariffs would force businesses to hire American workers ignored the harsh economic reality. Companies prioritize profits, and as long as labor remains cheaper overseas, they will continue outsourcing. While big corporations found ways to survive, another crisis was quietly unfolding. America's financial power itself was starting to weaken. The US dollar crisis. The US dollar has stood as the leading global currency, granting the United States substantial control over international trade for many years. But as the trade war dragged on, other nations began looking for alternatives. The result? A growing movement to dethrone the dollar as the world's default currency. A key factor in America's economic power is the ability to print money without causing massive inflation, because global demand for US dollars has historically remained high. However, as trust in US trade policies eroded, other nations sought to reduce their reliance on the dollar. This shift was led by the BRICS alliance: Brazil, Russia, India, China, and South Africa, which actively pushed for alternative currencies in global trade. China and Russia in particular have aggressively promoted transactions in their own currencies instead of the US dollar. Major oil-producing nations began accepting payments in Chinese yuan, undermining the petrodollar system that has long been a pillar of American economic dominance. The expansion of digital currencies and central bank-backed alternatives further accelerated the shift away from reliance on the United States. If this trend continues, the consequences for the American economy could be catastrophic. A decline in global dollar demand means the US government loses its ability to print money without severe inflation. This would reduce America's global influence, as countries become less dependent on US trade and financial systems. And while America's economic power was slipping, the US government struggled to control inflation, job losses, and financial instability. But could new technology and innovation change the game? The rise of artificial intelligence, automation, and self-powered energy. The world is undergoing a technological revolution that is rendering traditional trade wars meaningless. While Donald Trump's tariffs and protectionist policies were aimed at punishing foreign manufacturers and bringing jobs back to America, a far more profound shift was already underway, one that tariffs cannot stop. The rise of artificial intelligence, automation, and self-powered energy is fundamentally altering how goods are produced and distributed. Nations that lead in these areas will control the future of global trade, while those that cling to outdated economic models will fall behind. Automation is eliminating the need for low-cost labor, reshaping global manufacturing. In the past, companies outsourced production to countries with cheaper labor, such as China, India, and Vietnam. But now, robotic automation is making manufacturing cheaper and more efficient than human workers ever could. Factories that once relied on thousands of workers can now operate with only a fraction of that number, reducing the need for outsourcing. Countries investing in robotic manufacturing and AI-driven production lines are gaining a massive competitive advantage. At the same time, self-powered energy innovations are reducing dependence on fossil fuels and centralized power grids. Historically, industrial production has relied on oil, coal, and lithium-ion batteries, creating a supply chain vulnerable to geopolitical conflicts and trade wars. But a new wave of energy technology is changing everything. Countries investing in advanced solar, hydrogen, and microsonic energy solutions are freeing themselves from the global energy trade. This means that manufacturing hubs will no longer be restricted by energy shortages or dependent on oil imports. The shift towards self-sustaining factories and vehicles will break the traditional supply chain model, making tariffs irrelevant. For the United States, this presents a major risk. If America doesn't dominate artificial intelligence, automation, and next-generation energy, it won't matter how many tariffs Trump imposes. The real power will belong to the nations that control these technologies. Right now, that isn't America. While the US is still debating tariffs and manufacturing jobs, an even greater transformation is taking place, a revolution in energy. The energy shift, why the United States risks losing its industrial edge. The world is moving away from fossil fuels and lithium-ion batteries, embracing self-powered and renewable energy technologies. This shift is more than just an environmental movement. It is an economic transformation that could determine which nations thrive and which fall behind. China, India, and the European Union have already invested heavily in renewable energy, securing a strategic advantage. China is dominating solar panel production and battery technology, while India is developing massive wind and hydrogen energy projects. The European Union has accelerated its transition away from fossil fuels, reducing its dependence on foreign energy suppliers. Meanwhile, the United States has been slow to adapt. While some American companies are developing solar, wind, and alternative energy solutions, federal policies have been inconsistent. Trump's focus on reviving the coal and oil industries puts the U.S. at a disadvantage in the global energy race. If the world is moving towards self-powered factories, electric vehicles, and decentralized energy grids, America cannot afford to lag behind. The shift in energy isn't just about where nations get their power. It is about who controls the infrastructure of the future. The countries that lead in renewable energy and self-sustaining power will dominate manufacturing, logistics, and global trade. If the U.S. remains stuck in the past, it risks losing its industrial edge entirely. But energy and automation aren't the only battlefields. Technology is now shaping military power, and China is using it to expand its influence. The U.S. military and tech strategy. Can it compete with China? For now, the United States is still the world's dominant military power. Its defense budget is larger than the next 10 nations combined, and it maintains a global network of military bases. But military dominance no longer guarantees economic power. While the U.S. has been focused on traditional military strength, China has been winning the war of economic influence. China is using trade, technology, and infrastructure investments to expand its power without firing a single shot. Instead of military bases, China is building economic alliances through its Belt and Road Initiative. Instead of relying on weapons and force, it is using AI, robotics, and digital surveillance to shape the future of global trade. If the future of warfare is economic, then China may already be winning. The U.S. is still trying to maintain its old military-first strategy, but it may not be enough in a world where economic influence matters more than firepower. The challenge for America is clear: adapt or fall behind. The next global superpower won't just be the nation with the most powerful military. It will be the country that controls the world's economy, technology, and energy supply. Right now, China is closer to that goal than the U.S. The world is changing fast, but with Trump back in office, will his administration adapt to this new reality? Or will America fall further behind? Can Trump reverse the damage, or is it too late? Donald Trump's return to office has reignited the debate over his trade policies and their impact on the U.S. economy. His administration remains committed to the idea that tariffs can force other nations, particularly China, into fairer trade agreements. However, the global landscape has shifted dramatically since his first term. The effects of his previous trade wars still linger, and the world is no longer waiting for America to set the rules. In Trump's second term, lawmakers are deeply divided. Some insist that continuing tariffs will eventually bring manufacturing back to American soil, creating jobs and boosting domestic production. Others argue that the tariffs have already done more harm than good, raising consumer prices, hurting businesses, and pushing U.S. companies to move operations overseas rather than bringing them back home. With inflation still squeezing American households and economic instability growing, the pressure to rethink trade policy is stronger than ever. Beyond the economic debate, there is a growing realization that America's global influence is at risk. If the U.S. fails to adjust its approach, it could find itself permanently sidelined as other nations form stronger trade alliances without it. The key question now is whether Trump's administration will double down on its aggressive stance or pivot toward a more strategic, cooperative approach. But while Washington debates its next move, the rest of the world has already begun forging a new economic order, one where the United States is no longer the dominant force. America versus the New World Order. The rise of China, India, and the European Union as economic powerhouses has weakened America's grip. The world is shifting toward a multipolar economy where no single country holds absolute control. This transformation is not just about economic power, it reflects a broader geopolitical realignment that is reshaping global trade, finance, and technology. China has aggressively expanded its economic influence through the Belt and Road Initiative, securing strategic partnerships across Asia, Africa, and Latin America. It has also invested heavily in domestic industries, reducing reliance on the U.S. for technology and manufacturing. With its growing dominance in artificial intelligence, semiconductor production, and renewable energy, China is positioning itself as the leader of the next industrial revolution. Additionally, Beijing has been working to internationalize the yuan, increasing its role in global transactions and reducing dependence on the US dollar. Meanwhile, India has emerged as a rising superpower, attracting global investments in technology, manufacturing, and digital infrastructure. As Western corporations seek alternatives to China, India has become a prime destination for production and innovation. Its booming startup ecosystem, skilled workforce, and government-backed initiatives like Make in India have further strengthened its position. The European Union, too, has reinforced its economic standing by expanding trade agreements with major global markets, enhancing its role as a counterbalance to both the US and China. Additionally, the EU has pushed for stronger financial independence, reducing exposure to US monetary policies and sanctions. The shift away from US-led globalization is evident in the growing use of alternative currencies in international trade. Countries are moving away from the US dollar, reducing America's ability to leverage financial power. The BRICS nations, Brazil, Russia, India, China, and South Africa, have actively promoted alternative economic systems that challenge the dominance of Western financial institutions. Discussions around a BRICS-backed digital currency and increasing bilateral trade agreements using local currencies highlight a growing trend toward financial decentralization. If this momentum continues, the traditional global financial order could be permanently altered, limiting U.S. economic influence in ways not seen in decades. For the first time in modern history, America is no longer setting the global agenda. The question now is whether it can adapt to this new reality or risk becoming irrelevant on the world stage. If the United States wants to remain a major player in global trade, it must rethink its approach and embrace a new economic strategy. But what exactly needs to change? The future of the U.S. trade. If the United States hopes to regain its economic strength, it must take decisive action to rebuild its trade strategy. The first priority is revitalizing domestic manufacturing. While Trump's tariffs were intended to encourage companies to bring production back to the U.S., the reality is that many businesses choose to move operations to countries like Mexico and Vietnam instead. To reverse this trend, the government must create incentives that make manufacturing in America both feasible and profitable. Tax breaks, infrastructure investment, and workforce development programs will be crucial in making the U.S. competitive again. Another key factor is technological innovation. The next phase of global trade will be driven by artificial intelligence, automation, and clean energy. The U.S. must lead in these industries to stay relevant. Instead of focusing solely on protecting traditional industries like steel and coal, policymakers should prioritize the development of advanced manufacturing, robotics, and green energy solutions. Additionally, the United States must decide whether to continue its isolationist trade policies or reintegrate into global markets. While Trump's administration has promoted an America First approach, the reality is that no country can thrive in isolation. Strengthening alliances with key partners, such as the European Union, Japan, and Canada, could help counterbalance China's influence and create new economic opportunities. Trade agreements must also be modernized. The world is moving toward regional trade pacts and supply chain diversification. Instead of relying on outdated tariff policies, the U.S. should focus on strategic partnerships, digital trade agreements, and cooperative industrial development. Engaging in new trade negotiations that align with the realities of the 21st century economy will be essential. Finally, the financial system must evolve. If the U.S. wants to maintain its role as the world's financial leader, it must adapt to changes in the global currency market. The decline of the U.S. dollar's dominance means that Washington can no longer rely on financial leverage alone. Strengthening the domestic economy, managing national debt, and ensuring economic stability will be crucial in maintaining America's credibility in the global market. But even with these necessary changes, the ultimate question remains: can America reclaim its economic power? Or is this the beginning of its decline? Is America's economic power fading for good? The world is at a turning point, and so is the United States. Once the undisputed leader of the global economy, America is now facing an uncertain future. The choices made in the coming years will determine whether the country can reclaim its position or continue its downward trajectory. If the U.S. fails to adapt, it risks losing its place as the world's leading economic power. Other nations are advancing rapidly, securing trade agreements, investing in new industries, and reducing their reliance on American markets. The U.S. can no longer afford to rely on outdated strategies. The age of unilateral dominance is over. Collaboration, innovation, and strategic adaptation are the keys to survival. At the same time, America still holds significant advantages. It remains a hub for technological innovation, home to some of the world's most powerful corporations, and a leader in military and financial influence. But these strengths will mean little if the government fails to create a sustainable economic strategy. The world is evolving, and nations that embrace change will control the future. Trump's second-term policies will either accelerate America's decline or lay the groundwork for a resurgence. If his administration continues down the path of aggressive tariffs and trade wars, the U.S. could become increasingly isolated. However, if policymakers take a smarter, more forward-thinking approach, focusing on domestic investment, global partnerships, and technological leadership, there is still a chance for America to reclaim its strength. Ultimately, the final question remains: is this the beginning of the end for U.S. dominance, or can America fight back? The coming years will reveal whether the country is prepared to meet the challenges of the new global economy, or if it will be left behind as a fading superpower. What do you think? Can Trump's administration reverse the damage, or is America destined to lose the trade war? Let me know in the comments.